For clients receiving defined benefit pensions, it's important to ensure that the cash flow, the tax, and the Centrelink implications of that are accurately reflected in your modelling and in your projections. So during this session, we're going to take you through a few things. We're going to take you through how to actually enter in accurately and comprehensively the details of a defined benefit pensions using a combination of both profile and, very importantly, using your assumptions to be able to reflect the characteristics of a defined benefit pension. We're going to be looking at the outputs associated with a DB pension, namely cash flow and tax and Centrelink. We're also going to be looking at DB pensions that are paying over $100,000 per year and what that means in terms of its tax treatment due to transfer balance caps. And we're also going to be looking at death events and demonstrate how the reversionary nature of a DB pension can flow through to the spouse and how you can demonstrate that on the timeline in terms of goal achievability, as well as having that confirmed through your projections. So in the case of Ron and Jackie, let's just have a quick look at their profile. You can see here in the financial section, we have Ron receiving a PSS pension. You can go into the detail of that, where I've already entered in. Where he is receiving a defined benefit pension. The profile also captures when that pension actually started, and very importantly as well, the actual amount of the pension payment on an annual basis. And it's probably worth just highlighting how that information is captured in the financial tab of profile. Now, the reason I actually highlight the financial tab is that in the advisor tab, it actually does prompt you for additional information in regards to a defined benefit pension. So I can go into the advisor tab, I can click into there, and then it asks me for much greater detail in regards to the tax nature of the fund. It prompts me for the payment frequency, in this case it's fortnightly, being a PSS pension, and it also prompts me for the various tax components relating to that pension. Now, the thing to actually highlight is that in the current release, the goals modelling tool will effectively ignore all the information in the advisor tab in regards to the characteristics of the defined benefit pension. It will look at the financial tab and it will look at the actual pension payment amount as being a driver, but it will look at the assumptions of the defined benefit pension to project accurately tax and Centrelink calculations. So just by way of reinforcement, despite the fact that the advisor tab does prompt you for more information in regards to a defined benefit pension, and it's still worthwhile to actually populate those additional details for the purposes of data collection and data recording. For the purposes of modelling, that information is currently ignored, and it is the pension payment amount from the financial tab that will drive through to the actual modelling. Let's head to the timeline for Ron and Jackie, whereby they do have ongoing retirement expense goals coming through on the timeline. They also have a trip to Greece and the desire to build an outdoor area. Now, one of the first steps when you are looking at a defined benefit pension for the client is to ensure that the attributes of that defined benefit pension are accurately reflected in the assumptions in the starting position for the client. We'll go into the assumptions for this client and we'll scroll down until we actually reach the area dedicated to defined benefit pensions. Now, as you can see, that you have the ability to be able to reflect defined benefit pensions for each member of a couple. Ron is the only one with a defined benefit pension, so first thing that you'll notice is that it will prompt for something called a amount of death benefit payable. That's there to capture, in the case of a death event, the payment of a lump sum to a surviving spouse as opposed to a ongoing pension amount. It will prompt you for the funded or unfunded nature of the actual scheme itself. So you can actually turn that on and off to be able to reflect that. The other thing that you will notice is that it will default the deductible amount for the purposes of Centrelink to 0. Again, in the case of a death event, you can be more accurate in terms of the reversionary pension paid to the surviving spouse. That will just default to 2/3 of the pension, which is quite typical for most defined benefit funds. And if we scroll down a little bit further, it will prompt for the taxed and untaxed elements of the defined benefit pension. Basically, the way this operates is that you will convert the taxed and untaxed elements of a pension into a percentage, and whatever is left over will be assumed to be a tax-free component from the defined benefit pension. So just by way of summary, the assumptions page allows you to be able to reflect the actual nature of the scheme by indicating if the defined benefit pension is funded or unfunded. It allows you to be able to reflect the Centrelink deductible amount, generally which will be 10% of the actual DB pension amount. It will allow you to be able to nominate any reversionary income payable to a surviving spouse, and also allows you to be able to indicate the taxed and untaxed element of a DB pension. The thing to just be mindful here is that there's no validation here, so just make sure you don't go over 100% in terms of what you're indicating, and remembering that any leftover balance or unallocated amount will be allocated to the tax-free amounts of a DB pension. Here is a statement of a PSS pension. Here you can see the tax componentry being indicated as it normally is. You can see here that for the purposes of your assumptions, we've calculated that the $430 per fortnight based on the full pension payment amount equates to about 22%. Similarly, the untaxed element is about 56%, and the balancing item between the two is the tax-free component. So the way I would actually enter that into the system is exactly as is indicated here, both the tax and the untaxed elements of the DB pension in the assumption screen. The thing to keep in mind in regards to the assumptions is that it will default to a scheme being fully funded, and it will default to 100% tax component. In the case of Ron, he's a member of PSS, so I'm going to change that to a unfunded scheme. He's received $43,000 a year, so I'm just going to indicate a deductible amount for Centrelink purposes of $4,300, and I'm just going to keep this relatively straightforward, where I'm going to indicate, say, 20% is taxed, 60% is untaxed. Therefore, the remaining 20% of his pension payment will be allocated to tax-free component, and I will save that for the purposes of modelling. In the cash flow screen, you can see a few things happening here. You can see that his defined benefit pension is being acknowledged here. Remembering the cash flow screen always defaults to present value. Therefore, you're not going to actually see any change in his pension payment based on the default setting. If you wanted to demonstrate that for any reason, obviously you need to go to your assumptions and revert to future value to demonstrate the indexation. And also, unsurprisingly, in the case of Ron, based on the fact he's receiving $43,000 a year, and based on the componentry of his defined benefit pension and other sources of income, it's no surprise that he is paying zero income tax. Obviously, you need to refer to any technical resources that you have for the details in regards to that, but obviously the zero tax is a result of the fact that even though the untaxed component of his DB pension is subject to his marginal tax rate, let's say 10% tax offset, once you take into account other rebates such as the Senior Australians tax offset, his tax rate does go down to nil. Now, the other thing to note in regards to that is that obviously the age pension amount is being calculated on the basis of the defined benefit pension existing and the deductible amount. Just as a bit of an aside, for the purposes of improving your understanding and positioning of the goals modelling tool, and just demonstrate the power of what you're able to actually communicate to the client. And here is a really good example where you can provide the clients with enormous comfort in regards to their ability to be able to not only fund their lifestyle on an ongoing basis, but to also fulfill some of the lump sum goals that they have into the future. And I will just demonstrate and just contrast that with a more traditional view of how you would ordinarily communicate that to a client, whereby you would demonstrate what some advisors have indicated to me is the great big blue blob, and the client's goals are effectively relegated to these little blips. The use of a timeline is a much more visually appealing way in which you can reflect back and acknowledge a client's goals, whilst at the same time providing them with a very firm indication in regards to the prospect of them being able to achieve their goals. Let's just change up this example a little bit just to demonstrate to you how the model actually handles defined benefit pensions that are paying over $100,000 a year. So I'm just going to quickly go into the profile, and I'm just going to add $100,000 to Ron's defined benefit pension to make it a very generous one. Just reinforcing the benefit of having both the timeline and the profile open simultaneously, so you can go in and make adjustments. And obviously when you go back in, one of the very first things that you would want to do is obviously refresh all data from the actual profile itself. I'm not altering anything else in this particular example. If we were then to dive into the actual cash flow, you can see the impact in regards to tax payable is obviously changed dramatically in the case of a funded scheme, where it is that someone is receiving over $100,000 a year. 50% of the amount over $100,000 will be taxed at the marginal rate of the client. In the case of an unfunded scheme, effectively the 10% tax offset is not going to apply for the amount over $100,000, and the modelling tool does take that into account when it's calculating the tax payable associated with a defined benefit pension. And just as an aside as well, just to further reinforce, and unsurprisingly, with such a large amount coming through in terms of a lifetime income, they will not be entitled to receive an age pension. What I'm going to do in this particular case now is moving on to the next part, which is to demonstrate a death event. Is I'm going to revert back to Ron receiving a defined benefit pension of $43,865. Could be that for a very legitimate reason, due to Ron's health, or just Ron and Jackie being genuinely curious and maybe a little bit worried about what would happen if Ron was to pass away at age 74. Just to give a bit of an example, I would never ever have the death event already acknowledged in the scenario, either parked or unparked. As a general rule, events such as death or illness or injury or being unable to work, I believe very, very strongly should be entered in with the client rather than have it being shown on the timeline immediately. So here we're adding a death event. In this particular case, I'm just assuming that if Ron was to pass away, that both lifestyle and essential expenses would decrease by 20% to reflect the change in expenditure pattern for the household. As you can see, the death event has now been injected into the timeline, and just reinforcing that's done in conjunction with the client being part of that discussion rather than it being imposed on the client and already being on the timeline. And you can see what effect that has actually had in regards to the goal achievability of Jackie's retirement. So let's have a look a little bit more deeply why that's actually emerged. The basic retirement income goal for Ron and Jackie is $55,000 a year. The additional money that they want to spend in retirement is currently $10,000 a year, and both of those have moved from 5 bars down to 0 bars. Let's have a little bit more of a deeper look in regards to what's actually happened in the case of Ron passing away. Whilst Ron is still alive, you can see the full amount of his pension coming through. And if we were to move forward in the projections, you'd be able to see how it's still acknowledged as Ron's income, but you can see how the amount of the defined benefit pension has changed to reflect the 2/3 reversionary benefit that Jackie would be entitled to receive. The good thing about the model as well is that you can also see the impact on the age pension also emerging as well. So obviously, whilst we've acknowledged that the income associated with passing away, you can see also that changing here, essential expenses decreasing as a result of Ron passing away, but the combination of obviously the reduction in the age pension and the reduction in the amount coming through from the defined benefit pension is obviously going to have a detrimental impact on Jackie's ability to be able to maintain a lifestyle of that level. And this may be a situation where you can start setting expectations in regards to the impact of that, and this is even despite the fact that a reversionary benefit on a defined benefit pension may exist. So by way of summary, just keeping in mind that it is the assumptions that will be driving tax and the Centrelink calculations. In terms of outputs, you obviously have the ability to be able to see not only the cash flow associated with a defined benefit pension, but also the tax impact and the Centrelink impact associated with that. And obviously you have the ability to be able to reflect a death event, demonstrate the impact of not only the 2/3 reversionary benefit, which is typical of a defined benefit pension, but simultaneously you'll be able to demonstrate future age pension entitlements.